Stocks perk up on hopes of an India-US trade deal after America's Vietnam trade pact. IT and energy lead the charge, while utilities drag.
DMart owner Avenue Supermarts takes a knock after missing estimates on Q1 sales and concerns over rising competition from quick commerce that some analysts believe can also dent margins going forward.
The stock of FSN e-commerce, promoter of Nykaa, sulks after early investors Harinder Pal Banga and wife Indra Banga sell over 2% equity for near 1,200 crore rupees. Fears of further selling is an overhang.
Karnataka Bank Chairman tells CNBC-TV18 that the recent exits of its MD and ED won't stall any new business initiatives and the profitability of the bank will improve in the coming months, even as the hunt for a new managing director is on.
CNBC-TV18 learns that negotiations on an India-US interim deal are in the final stages, with sticky points being a greater access for India's labour-intensive industries and some protection for its farm and dairy sector.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's been a decent afternoon so far. For the last few trading sessions, the Nifty was consolidating lower. Today, it is consolidating mildly higher. Even as the Nifty Bank faces some resistance around that 57,150 to 57,180 sort of mark, it will be very interesting to see where the second half of this trade goes. And that's largely on account of the fact that it's a Thursday today, which means it is Nifty weekly options expiry. Hi, Vinny.
Hi, Mangalam. Good afternoon. After those couple of days of consolidation, at least Nifty had recovered from the day's lowest point so far today. Broader end of the market, as of now, is managing to hold on to some bit of a gain. Now, what's not doing well, like you mentioned, banks, that's down and out. But autos, that's managing to hold on to gains, as well as media is managing to do well in today's trading session. So those are some of the names. And with that, mild gains coming in for IT as well as metals is what we're watching out for. So an interesting day surely coming up there, but a lot of updates that have come in on operational front, and especially on the FMCG retail side, and banks also are there. But let's start with retail then.
Yeah, so before the result season, there's always the result preview season. That's exactly what is taking place right now. Yesterday, we got numbers from Avenue Supermarts, V2 Retail, as well as Bazaar Style Retail. Let's talk about Avenue Supermarts. The company reported a 16.2% jump in their revenue year on year. Remember, the last 3 or 4 year compounded rate has been around 17.3%. Analysts themselves were pegging anywhere between 17.5% to 18%. So to that extent, it's been a mild miss by about 1.5%. But remember, consumer sentiment itself has been weak. The festive season actually shifted in the previous quarter as against this quarter. So, which is why the company has reported 16.2%. The thing is that they've added 9 stores during this quarter. And if you look at the total number of stores which have been added over the last 4 quarters, the store addition year on year is 14.3%. Store addition, 14.3%, revenue growth, 16.2%. What does that mean? That there is some same-store sales growth. Morgan Stanley pegs that to be 3 to 4%. Could be anywhere between 1 to 3% itself for the same-store sales growth. But the street believes that maybe, this is slightly below expectations, especially at a time when margins are something we'll be watching out for. There is high competition in the large metros from quick commerce players. And which is why we will watch out for product mix improvement, the store opening plan for the company. Have they increased the pace of store expansion? And finally, the scale-up of DMart Ready, with the company reveals in its consolidated numbers. We will watch out for that when the numbers come by. For V2 Retail, we have revenue growth of 51%. On a high base, it's grown very well. But the reason why the stock is mildly lower is because it's largely come on the back of store expansion and not so much on same-store sales growth. Same-store sales growth is just 5%. Even if you adjust for the Eid factor, which moved into the 4th quarter, the company says it is about 10% in terms of same-store sales growth. Bazaar Style Retail, that one is another stock which is lower after opening higher on a 37% revenue growth. The same-store sales growth was actually a negative because, again, the festive season shifted in the previous quarter. So if you pull up the intraday chart of Bazaar Style Retail, you would see that the stock that opened higher has now moved lower and is currently at the low point of trade. So we'll watch out for that one. That is Bazaar Style Retail, down about 8% from the highs. That's not the only stock which is on our radar, though. We also have GMR Airports, which is in focus. This after the TDSAT has quashed Airports Eco-Regulatory Authority's earlier hybrid regulatory asset-based calculation for the Delhi airport. What does this mean for the stock and the company? Vivek joins in. Vivek.
Well, that's right. A very important development as far as GMR Airports is concerned. It's a directional positive, and there could be some past dues too that GMR Airports could hope to accrue from this particular development. So like you rightly mentioned, the TDSAT, which is the Telecom Dispute Settlement and Appellate Tribunal, went ahead and recently squashed the Airports Economic Regulatory Authority's earlier hybrid regulatory asset base, which acts as the notional tariff base for calculating the aero as well as non-aero tariffs. This relates, or this particular case pertains to the Delhi International Airport. So now, what's actually happened is that the TDSAT has said that AERA's method is incorrect to go ahead and calculate the hybrid, when you're talking about the hybrid regulatory asset base. So the base on which aero as well as non-aero tariffs has been calculated has been deemed incorrect, indicating that there will now be a higher base which will be taken into account, indicating that there could be further tariff hikes that GMR Airports could enjoy. Jeffries has written on this particular development. They say that if the final ruling favors DIAL or Delhi International Airport, the revised HRAB could significantly raise allowable tariff recovery due to past under-recoveries. Along with that, they say this and other debated under-recoveries could mean major upside to Delhi Airport's tariff as well as profitability.
Okay, Vivek, thank you so much for that. So those are some of the stocks that we're keeping an eye on, and keep an eye on some of these pharma healthcare names as well. They are buzzing in trade. Aster DM, we have Eros Life Sciences, Narayana Hrudayalaya, which are also buzzing in trade. So keep an eye out on the broader end of the market specifically. But on that note, we're going to actually step into a very short break. Up next, we'll get chatting with the management of Godrej Industries on their mega capacity expansion plans that they have. So stay tuned in for that.
Welcome back. Good time to look at the F&O setup of the market right now, and that's largely because it is, 2 hours ahead. 2 hours from now, we'll have the expiry, 3 hours, 20 minutes to be precise. So we'll keep an eye out on the Nifty, which is up around 50 odd points. This is off the day's high, slightly over 25,600 was today's high, coincides with yesterday's high as well. And the Nifty Bank is the one which was under pressure in yesterday's trading session as well. Today too has moved mildly off highs. No problems with the mid-cap index, which is holding higher by about 1/3%. And we have, some of the important stocks, the large cap stocks, doing a lot better and supporting the frontline index. So we have HDFC Bank, which is up 2/3%. Reliance is up, 2/3%, as is Infosys. So if these stocks continue to hold up, then, the lower end of the Nifty would see a fair amount of support. The advance decline too is in favor of advances. Even though those lines have come closer, now they're diverging a little with the green line on top of the red one. So that's a positive. The 25,400 call has been very active in today's trading session. All those call writers have begun to cover their positions. The question is whether the higher level call writers will also cover their positions or not. The 25,500 put writers also equally active, premium of 20 rupees, telling you 25,480 thereabouts could be strong support. In fact, the levels that we are right now are very close to a level from where there can be a bounce, which is expected. And the 25,600 call writers too have begun to unwind their position. So are we bracing ourselves for an up move in the last hour of trade or not is the big question that option writers are positioning themselves for. Fresh longs added on Blue Star. We had the management join us this morning on the channel as well. Over the last few trading sessions, we've seen, a lot of these consumer durables being very well bid. There was Voltas, there was Amber and Blue Star as well, seeing some long positions being added. Fresh shorts have been added on Avenue Supermarts, but remember the stock has recovered from the lows. At the low point, it was down around 4%, so it's about 1.5% recovery from lows. If these shorts continue to maintain their positions, then and the stock continues to recover, then there could be some short covering on Avenue Supermarts as well. So we'll watch out for that stock. Vinny.
Absolutely. So that'll be interesting to watch out for, especially given that it's Nifty weekly expiry as well. But on that note, let's bring on the first management for today. We have Godrej Industries that had actually announced significant capacity addition under which it will invest 750 crore rupees in the chemical business for expansion. Now, to discuss their capex plans, the business outlook of the company, we have Vishal Sharma, Executive Director and Chief Executive Officer of the chemicals at Godrej Industries, joining in with us to talk to us about their business. Thank you so much, Vishal, for joining in with us this afternoon on the show. 750 crores for this chemical business is what you all have planned. One, what is the time period over which you all will be making this investment of 750 crores? And what is the asset turn that is expected for the same as well?
So the time period, first of all, thanks for having me. And, the company is on an expansion plan. We are looking at becoming a $1 billion business before 2030. So we are not giving it too much time. We want to move fast. This capacity expansion that we've announced, which involves 750 crores, is to be spent between now and roughly 2028. So between now and the next 3 years is what we are talking about. And let me also add, this will not be the only investments that we'll be making. There'll be more coming. So as we decide to make further moves, we'll be announcing that as well.
So roughly, I would not like you to say something to us before you say that to your board. Roughly, what is the capex plan that you have from now to 2030 to reach that $1 billion target? And also, what is the internal rate of return that you are expecting in all these investments that you are making? What are the asset turns in a business like yours typically?
So let me answer the first point. When we say the total investments, so we are talking about 750 right now. There'll probably be another 400 to 500 going in. Now, I can't give exact numbers naturally, so I'm giving you, just a range. There'll probably be another 400 to 500 going in as we get towards 2030, because we'll need that. When you say asset turns, it can be defined in different ways, but I'll probably put it like this. I think these investments that we are making will give us an annualized revenue of a couple of thousand crores. Probably even more than that, probably up to 3,000 crores. So that'll be the impact that this will have on us. You asked about IRR. That's not a number I'd like to share right now, but what I will say is that it'll be above industry average IRR for sure.
Okay, above industry average IRR and couple of 1,000 crores additional revenue is what you're talking about, right? From this capacity addition that we're talking about.
Annually, yeah, that's right.
Yeah, okay. And the funding right now, what is the funding situation like? Will this be through internal accruals? Would you have to raise some money? Could you explain us that as well?
Yeah, great question, actually. We are a pretty well-performing company financially. This entire spend will be funded by our business itself. So we'll be generating enough cash flows, enough EBITDA to fund this ourselves. There'll be no external borrowings being taken for this.
All right, no external borrowing for that. 750 crores over 3 years obviously would not require you to take any more money. Your geographic expansion strategy, if you could state that as well, because currently 30% of your revenue is coming from exports is what we understand. For you to reach the $1 billion mark, how much of that would be export-led? How much of that would be domestic-led? Also, because there is so much uncertainty around trade, tariffs, etc., right? The global environment is not as smooth as what it was, say, in the last 5 years or so. So going forward, what's your strategy here?
So we consider ourselves to be fortunate that we are in India. A large market, largest population in the world, a growing market. Yeah, the growth may have tapered down a little bit recently, but medium to long term, we are very, very bullish and confident on the Indian market. So currently, domestic to international revenues sit somewhere around 75-25. The aspiration is to take this to about 60-40. Because when we look at market shares, we've got a much higher market share in India than we have internationally. So we want to keep growing the India domestic business in strong double digits. We want to grow the international business in very strong double digits. When I say that, I'm talking of 25% upwards. So as we go forward, we'll probably end up at a 60-40 kind of ratio.
So domestic grows upwards of 25% and international grows between 10 and 15%.
So domestic will grow double digits. So let's say between 10 to 12%. International will grow 25% upwards on an annual CAGR basis.
The other way around. Got it.
Okay. 25% plus growth for exports. You're going to be expecting that in the international market. Just one more point I want to understand, given these geopolitical tensions, could you highlight any concerns that have come in right now for exports on the freight cost front or container availability, any issues that you've seen in the recent times? Because there was a lot going on, whether, in the recent past, obviously there was Russia-Ukraine because of the Red Sea issue. Then we had the Strait of Hormuz issue, which came in. No closing of that, but any concerns or increase in rates that you have specifically seen?
So let's take it one by one. When we talk of geopolitics, let's talk of the Trump tariffs or the US tariffs. I think we got to deal with issues like that. We are seeing wars happening in multiple places. It was only one, then it became two. We don't know where the third one is coming from. So I think building agility inside the business, inside a management team, with our entire business construct and ecosystem, I think we've done that fairly well. So we ensure we are managing the whole value chain in a manner where even if we have some disruptions in different places, we are able to deal with it. And that's going to be an ongoing process. I think all of us in business have to forget about a world which is completely stable. That's probably history now. And we need to be prepared for ongoing, black swan events coming up on a continuous basis, probably annually or even twice a year. Coming to your point on container freight rates, etc., yes, that is also part of the ongoing, dynamic business environment, I would say. We got to keep adjusting prices. We take positions in the market as far as our raw materials go. So we import raw materials as well. We have a bunch of exports as well. I think this is ongoing management. This is not something you can plan for today, saying this is what I'll do 6 months down the line. The event happens. You need to think about it. You need to have a contingency plan in place. And when the event happens, you trigger the contingency plan and act. That's how we've been doing it fairly successfully. I'm confident with my team, we'll continue doing it successfully in the future as well.
Right. You've been giving us a fairly detailed outlook for the future of the company. On the top line front, yes. On the geographic front as well. You've been talking about the near-term concerns, etc. as well. Yeah. From the operational standpoint, if you could give us a sense on what kind of margins are you targeting? Because if I look at your, pre-tax profits, your margins are high single digits, between 8 to 9%. And I ask this specifically because when you're looking at that $1 billion target, say a few years from now, what will that revenue comprise of? How much of that will be specialty? How much of that will be core chemicals? How much of that will be value driven? How much of that will be volume driven? And as a result of which, what happens to your margins?
So I won't talk specific margin numbers here, but I will give you the broad picture. So let's talk of it as bulk versus specialty. Yeah, I won't use the word commodity because what we call as commodities are actually essential products that we sell. Yeah. Customers can't survive without those. It's a necessity. It's like cement.
So we're not saying that commodities are inessential. We're just saying they're commodities.
Well, we prefer to call them as essentials. I'll put it like that. Yeah. So when I look at that, we currently have about a 80-20 ratio between the bulk and the specialty. This ratio will change as we go forward. So when we are talking about the investments, a significant part of the investments, half of them or even more than half, are actually going into a specialty space. We are significantly focusing on the biotech space, making products, green products using fermentation technology. That's an area we are specifically making investments in, both in terms of infrastructure as well as in terms of R&D. So the 80-20 which we have today is probably going to become 60-40 and maybe even 50-50 as we approach 2030. That's the plan we have, and hopefully we'll get there.
And what does that do to your operating performance? Because obviously specialty will have a couple of 100 basis points higher margins, right?
The specialties and the biotech will definitely have a higher margin profile than a current margin profile. So
what's the current split right now? What's the current split?
80-20 roughly right now.
No, in terms of margins, what?
So currently the specialty and biotech margins are above our average margins by at least 4 to 5 points.
4 to 5 percentage points. So that's 4 to 500 basis points. If that increases by 30 percentage points in your calculation, then you're obviously looking at low double-digit sort of margin at a $1 billion revenue front. The street likes that because the stock, which was marginally in the red while you were talking about your plans, it's moved back into the green. That's not to say that, we're so minutely observing what's happening here. But the important question from a Godrej Industries standpoint, a lot of people who buy this stock are also buying a lot of holding company discount because of the portfolio that you have. Has there ever been any consideration of, unlocking some of the value in the stocks that you hold? Because we're looking at the kind of moves that we've seen in either Godrej Consumer or Godrej Properties. At the same time, Godrej Agrovet was a good value unlocking exercise earlier. You hold almost 91% stake in Godrej Capital as well. We saw what happened with HDB Financial and a lot of these other companies which are looking to list their financial arms. So have you looked at these parts of the business at some point?
So actually, that's a question I would have, probably Pirojsha Godrej answer. I don't think I'm the right person to be answering that question.
All right, take that point. We will definitely pose this question to Pirojsha when he joins us next. For now, thanks a lot, Mr. Sharma, for joining in and giving us the outlook on your business for the next few years. With that, we'll take a short break. Come back. Aditya Agarwala of Invest for Edu joins in with some trading strategies.
Welcome back to Halftime Report on CNBC-TV18. Now we have Aditya Agarwala joining in with us from Invest for Edu to talk to us about the technicals on the market. Aditya, good afternoon and thank you so much for joining in with us. Obviously today is expiry day. Right now we've seen a bit of a run-up coming in the stock from the day's lowest point, 25,500. Nifty is holding on to that. But what are the levels that we should keep an eye out on today?
Good afternoon, Vinny. Thanks for having the show. 25,000 actually happens to be a key support area for the market. If you take a look at the options data today being an expiry day, there's a lot of put writing that you see that's taking place between 25,400 to about 25,500. With a lot of open interest built up, especially on 25,500. With having said that, there's a lot of open interest that is also building on the 25,500 call and 25,600 call as well. So my sense is market will try and expire between this zone of 25,500 or 25,600 on the upside. And it's more of a consolidation. If you take a look at our last few trading sessions, nothing really much, so to say, on the headline index. 25,700 is a stiff resistance, 25,400 is a good support area for the market. And towards the fag end of the trading session being an expiry day, as I mentioned, I think markets could scale closer to 25,600 and expire somewhere there. Same holds true for Bank Nifty. If you take a look at it, it's more of a consolidation that you're witnessing on the Bank Nifty as well. Nothing much really to read between that. So 57,500 is a major hurdle for the Bank Nifty as of now. And as we speak, 56,900 or 57,000 is a good support area. So it's almost there, Bank Nifty. My sense is towards the end, you could see some bit of a short covering rally, both on the Nifty and the Bank Nifty.
Take that point towards the end, of short covering. That's what the data is suggesting as well. Speaking about short covering, moments ago we had highlighted Avenue Supermarts. A lot of short positions added on that stock, and the stock has recovered a fair bit from the lows. Right now, as we speak, just pull up the intraday chart, you would realize that at the low point, the stock was down 4%, and now is nearly erased all of its losses. It's down by just about 1.5%. So just watch out for that one. A lot of shorts in the system. Stock's recovering from the lows. If it continues to move higher, then these shorts will have to unwind their positions. Individual stocks, are you playing on the long side or the short side?
I'm playing on the long side because Magalam, I am waiting for a short covering rally. So a couple of stocks. One is Pidilite, looks interesting. And there's a change in texture also. If you take a look at the market, it's moved towards FMCG and two-wheeler space. So Pidilite is something which is looking interesting to me at current levels. We'll buy for a target of 3,250 on the upside, place a stop loss of around 3,070 on the downside. A good move in the offering can be seen in Pidilite. Second, from the two-wheeler space, Hero MotoCorp is something which is looking very interesting. After a bit of a consolidation, looks like stock is poised to cross its 200 DMA. So at current levels, they'll be buying Hero Moto for a target of 4,450 to about 4,500 on the upside. Place a stop loss around 4,250 on the downside.
Okay, Aditya, thank you so much for joining in with us today, giving us those individual stock names that you're watching out for, as well as the levels we should keep an eye out on in terms of the Nifty as well. Thanks for joining in with us. But on that note, let's slip into a very short break. On the other side, we have Manisha Gupta joining in with us with Surendra Mehta, Secretary at Indian Bullion Jewelers Association. So stay tuned in for that.
Welcome back, and joining us now is Surendra Mehta. He is Secretary, India Bullion and Jewelers Association. Mr. Mehta, hi, thank you for joining in. And there seems to be a bit of a calm right now in the international markets. It's a risk-on trade, more trade agreements are happening, and the geopolitical tensions also seem to have taken a backseat, at least for now. And that is the reason you're looking at the gold price is very, very consolidating within a range there. Interestingly, having said that, we haven't seen the prices go below 3,200 or so. In the current kind of a scenario, what's your sense on where really could the gold prices go?
To understand one important thing, that after the geopolitical tensions have reduced, the new thing which is coming next week, especially for India, is the tariff deal. So as far as India is concerned, Indian gold market is concerned, I suggest all traders to remain very, very careful, because this tariff deal can finally end up having gold import from USA in a bulk quantity. And currently we are having 45 billion trade deficit with USA, and probably the entire game is not only about the trade deal or a tariff deal or a gold deal, but it is about the currency. So the currency is likely to become very, very volatile. And I think that is the reason why the market, India being one of the major importer for gold, the market is slightly calm and moving in the same range. There can be a deal with the USA, wherein USA may like to export gold to India, and with a preference, because currently we have a preference of import of gold from Dubai, wherein we pay only 5% duty against the normal duty of 6%. But if the preference is to be given to USA, then probably we'll have to go for further duty cut if we import from USA. So I would suggest all traders to, this calm market is actually a good for them, and not to carry over the trade for the next week at least.
All right, that's a cautious voice coming in. And but what's your sense on the prices itself? Because that takes in way more than just the US and India trade agreement, clearly, way more fundamentals and factors within that. How are you looking at the prices from here on?
Yeah, prices in the international market, I'm still very, very bullish because the prices are not going below 3,200 level, as you rightly said. It's almost moving in the similar direction how the silver moved. Silver were consolidating between $32 to $34, and we suddenly saw a surge in silver prices to $37. Something similar is likely to happen here, because there are non-farm payroll data. The US is likely to get into recession. There can be an interest rate cut. And all these factors, only one factor has reduced, that is the geopolitical tension, but other factors remain as it is. So in my opinion, I'm still very bullish on gold. It may cross $3,700 to $3,800 maybe in next 1 or 2 months.
Also, how would you look at the Indian demand now? We've all been waiting for a consolidation. We all understand that the last month or the last quarter wasn't such a great one. Again, most jewelers have come around and told us that the demand or the sales has been 40, 50, even 60% down for some of them. Do you see that improve as we go ahead?
Yeah, especially after the gold price crossed 1 lakh mark in the Indian market. Let me tell you, from the first week of June, the demand is on the retail counters are nearly down by 70%. And I think the Indian consumers are not able to digest the gold prices above 1 lakh rupees. And if this remains the story and whatever I think that gold prices are likely to go higher, it is going to be the tough quarter with all the festival season in the next quarter. I think Indian jewelry sector is going to have a difficult times in the next quarter.
Okay, could see a difficult time in this quarter, though prices could go up, is what is the word coming in from Mr. Surendra Mehta. Thank you so much, Manisha, as well as Mr. Mehta, for joining in with us for this interesting conversation there. But with that, we'll actually sip into a very short break. We'll get you more on the markets and stock-specific action on the other side.
Welcome back. Aditya had spoken about auto stocks and how he was positive on Hero MotoCorp. Just pull up a couple of these consumption names. So you have Bajaj Auto, which has moved higher, Maruti Suzuki. Okay, these are all entry-level consumption, themes that we were talking about. M&M2 has moved to the high point of trade. But the newly listed stock, HDB Financial, is up in trade today after a good listing yesterday. So between yesterday to now, the stock has rallied almost 20%. After this 20% jump, what does the valuation mean for the company and how does it compare with peers? We have Gaurav joining in. with the details. Gaurav.
Well, yes, HDB Financials is definitely in focus, and the reason being that this 1 lakh crore company has grown at around 20% over the last 4 years, and even when we look at the valuations and the listing, we saw a listing at 13% premium, which was still trading at 3.4 times price to book value, and it still looks comfortable. And the reason being that there are some positives and negatives for the company. First, let's talk about positive. When we talk about gross NPAs, company has shown over the last few years, they have actually reported gross NPAs which were lower than its peers. Other than that, the product portfolio mix is very unique, and that is the reason why it brings company with a new perspective, with 73% of its loan actually linking to the secured loan portfolio. It gives upper edge to the company when we compare it with the peers. On the other hand, when we talk about profitability, there also we saw over the last few years, company has shown profitability growth of around 30%. On the flip side, when we talk about negatives, there are some factors which could act as a hiccup to the company. First is when we look at AUM growth, it is actually a little lower than we compare it with the peers. At 20%, we have already seen some peers growing at a CAGR of around 30% over the last 4 years. Second factor is the ROA. When we look at this profile, HDB Financial's ROA came in at around 2.2% for FY25, again a little lower than other companies, and the reason being that credit cost was a little higher, and from what we have picked up from the management commentary, credit cost is likely to stay at around 2%, which leaves a little upside for ROA, and that is another concern for investors. Now, considering all these factors, even at this price, when we look at price to book value, 1 year forward price to book, implied price to book comes at around 3.5 times, which is still comfortable. In fact, we also did a little bit of valuation analysis. Even if the stock is trading somewhere in the range of 1,000 rupees, which is 30% upside from its listing price, it will still give price to book of around 4 times, which is still comfortable, because when we look at other peers like Cholamandalam Investment and Bajaj Finance, they trade somewhere in the range of 4.5 to 5 times price to book. Another thing to point out here is that when we look at some media reports, it suggested that the unlisted price for HDB Financial was somewhere in the range of 1,200 to 1,300 rupees. Now, this price is a little unachievable at this moment, and the reason being that considering all these factors, the price to book, implied price to book for 1,200 rupees would come somewhere in the range of 5 times, which is a little difficult. But for now, it seems that the stock is trading comfortably in the price to book value of 3.5 times.
Okay, Gaurav, thank you so much for that analysis that is coming in on HDB Financial Services as well. Thanks so much for that. But on that note, step into a very short break. On the other side, we'll connect with Shweta of Elara Securities to discuss what we're watching out for in Q1 FY26 from NBFCs, understand M&M Financial's Q1 updates as well. Welcome back to Halftime Report on CNBC-TV18. Now we have Shweta Tapdar, Vice President at Elara Securities, joining in with us to talk to us about the NBFC space. We have a lot of Q1 updates that have come in also overnight. Shweta, good afternoon. Thank you so much for joining in with us. M&M Financial, Zireda, Hindalco, a lot of banking names also have come in with their numbers so far. What are you making of M&M's financials? Seems like weak disbursements that has come in. But as of now, the stock is managing to hold on to gains. What are we watching out for now? And what is your outlook here?
Yeah, good afternoon. So yes, few business updates have already been announced, and Q1 traditionally tends to be a subdued quarter seasonally for most of the NBFCs, especially for CV financiers. The challenges will continue to persist for the full year as we move ahead. Second is, if you look at the NBFC space, entire FY25, most of these NBFCs have navigated distinct challenges in the nature of developments on the regulatory front. And second is the asset quality woes, which have remained sticky in the unsecured and microfinance space. So the outcome of these two factors will be slightly anemic growth, which will weigh on earnings for Q1 FY26.
Right. And what about Zireda and Hindalco? You know, if you could give us a sense on what you've made of the updates that have come in from there as well. And what's your outlook here?
Yeah, so capex-driven stocks, I believe, will be gradually back in reckoning. And PSU financiers like Hindalco and Zireda, we definitely continue to maintain a positive stance. Particularly in Hindalco, if you look at the numbers, highly likely the loan growth scenario remains pretty healthy. And we are estimating around 25% AUM CAGR for next 2 to 3 years. Considering how the power finance space and the infra financing has been in limelight, especially after a relaxation of infra provision financing norms. I think PSU financiers are back in reckoning. For next 2 years, given that power is a very long-term story and this government is pro-infrastructure, I think HUDCO and IRIDA, despite the expensive valuations, are still nicely placed from a long-term perspective.
Okay, nicely placed from a long-term perspective, even after these valuations, is what you're highlighting. Shweta, I just want to understand overall for Q1 FY26 from NBFCs, what should we be expecting? Would they be doing better than banks, given that obviously those rate cuts also have come in? So how does NBFC fare in Q1 FY26 this time?
Yeah, so the current positive liquidity scenario and the low interest rate regime definitely bodes well, especially for upper layer, high credit rated NBFCs. So next 2 quarters definitely look pretty stable for NBFCs. However, case-to-case basis, microfinanciers and credit card players definitely still are reeling under pressures as far as asset quality is concerned. And in fact, we also believe that now the focus has shifted from asset quality challenges to business augmentation obstacles. So given the fact that there have been a plethora of regulatory changes, most of the microfinanciers and credit card players have to go back to the drawing board, rejig the operational systems and dynamics, and that will have interim pressures on loan growth. Second is from the margins perspective, at least in the first half of FY26, we do not see a major uptick in margins primarily because the pass-through or the transmission will happen only in the second half of the year. So second half probably could be better on the margins front. On the asset quality front, although the credit costs have begun to decline, but it's too early to call on the asset quality woes are completely behind. So net, not a very exciting quarter in Q1 for NBFCs, but definitely the year looks pretty stable as the regulatory environment, the macros have turned favorable.
I'm sure you haven't assumed any formal coverage on this one, but the stock of the last 2 days has definitely been HDB Financial. I wonder whether you went through the RHP and if you have any sort of view here.
Yeah, Mangalam, so I'm very positive on HDB Financial Services, especially from 2-year, 3-year perspective. Currently, Elara as a house and myself, we are confident and placing bets on diversified product profile businesses. I think that's a need of the hour. And coming back to HDB Financial Services, a well-diversified, balanced, granular retail profile concentrated across MSME, LAP, vehicle loans and consumer credit, and operational in the small ticket segment, like 1.65 lakhs is their average ticket size. Over 70% of their branch network is situated beyond top 3, top 4 markets. And if you look at the financials from the financials perspective, as on today, where HDB is standing, while the credit losses have been in the range of 3%, and they definitely faced headwinds post or during pandemic, now they are poised on and sitting at an inflection point. So we believe 20%, 19 to 20% AUM CAGR and closer to 18-19% ROEs are imminent. So that juxtaposed with the high credit rating, the strong parentage definitely puts HDB in one of the top tier NBFCs, and considering the valuations, 3.4, 3.5x forward book multiple, vis-a-vis say Cholas and Bajaj Finance of the world, I think it's a very good fundamental bet.
Do you have a published target price on this one?
Not yet.
Got it.
Okay, Shweta, thank you so much for joining in with us this afternoon on the show, helping us understand NBFC is what we're watching out for this time as well in terms of Q1 FY26. But with that, we'll wind down this edition of Halftime Report on CNBC-TV18. Thank you so much for tuning in. Up next, Business Lunch to take all the market action forward.